Well, I think the joke that I made was about PE. Actually, it wasn't even a joke. I was using Tesla as an example for why PE ratios are important, and you were able to articulate why Tesla's not as crazy as I thought, right? So I was like, well, the S&P 500 averages like 15 to 20 price to earnings ratio, and Tesla was at like, I think 1,200 at some point in the last year. And I was laughing when everyone's like, Tesla's amazing, buy in. And I was like, the one metric that I understand says no. In fact, I actually bought the Tulip Mania poster and framed it and put it on my wall during that time. And so I guess we could probably pick up from there and see, what are the flaws in my logic?
So I'm not going to make an argument for a second that Tesla is cheap. Like, that's not the point of anything that I was saying. The point of that discussion was I was trying to point out that the PE ratio is a great metric when it works. And there are some companies, in fact, lots of companies, that the PE ratio does not work on. That's not to say that the PE ratio is a bad metric. You just have to understand the phase that a company is in and how a company's growth cycle works. So I'm going to put a little image on screen here. Okay, so this is, roughly speaking, not perfect depiction, but roughly speaking, what happens when a company goes from startup all the way through its decline phase. So this is the assumed growth path of an extremely successful business, basically one that goes from like a startup to Dow component all the way until it's the decline phase. After a company gets started, there's no valuation metric that you can use, right? When Apple was first getting started, it didn't have revenue, didn't have profits. So there was no PE ratio. There was no price to sales ratio. It was just an idea on a piece of paper. Once the idea is launched to market, that's when a company often goes through a very rapid growth phase, when all resources at the company are devoted to grabbing customers, grabbing market share, and growing the top line. It's very common for companies that are on this stage of the game to actually be spending more money than they are taking in because they're hiring like crazy. Lots of the successful growth companies today go through this phase, this extended period when they're actually losing money. Now think about that. If they're losing money, what would the price to earnings ratio be? The earnings are negative, right? So the PE ratio is useless in this stage. As this company grows and matures and it starts to scale out, eventually, if it's successful, it reaches a break-even period when it's now bringing in enough revenue to cover its costs. So its earnings are now zero. That's a major improvement from earnings being negative previously. During this phase, though, a company goes from being unprofitable to having a minuscule amount of profits. Now, if you were to see this in the market, what would the company's price to earnings ratio be? Earnings are teeny tiny. The price is likely to be high. So in this phase, it's common for these companies to have PE ratios of 1,000, 10,000, 500, whatever the number is. That's because the company is not yet optimized for profits. It's optimized for growth. However, as the company continues to scale out and its margins continue to rise, eventually it reaches enough scale where management shifts its focus from exclusively driving the top line higher to starting to focus on the bottom line. At this phase, the company's earnings power, the true earnings power of the company, is finally on full display. And when a company's margin profile is fully optimized, now the earnings number is maximized and the price to earnings ratio suddenly becomes useful. The tricky thing that investors get, the way that investors misuse the PE ratio is when the company's in phase 1, phase 2, or phase 3, they look to the PE ratio, which is often negative or in the thousands or in the hundreds, and say, overvalued. How could it be? The PE ratio of the S&P 500 is 15, 20, whatever. This is 1,000. It's overvalued. What they're doing is they're applying the wrong metric at the wrong time. So with Tesla right now, Tesla is still in this phase 3. It's still in the hyper growth phase. It is profitable, but it is rapidly approaching the period that when its profit margin is maximized. So here's the company's profit margin over the last, say, 5 years. So in 2020, this is a zero right here. This is when the company reached break even. 2020. So when you were looking at the PE ratio, you were looking here when the company just barely crossed over into the earnings mark. And this is when its PE ratio was, let's see, 1,000, right? Because the earnings were so minuscule because it just crossed over into break even. Now, if we look at the company's profit margin, it's 14%. That means for every dollar in sales, Tesla is creating 14 pennies of profits. That's about as good as it's going to get. So right now, all of a sudden, the PE ratio is meaningful for Tesla. So Tesla's PE ratio right now is about 110 when looking backwards and 74 when looking forwards. So the PE ratio fell from 1,000 all the way down to 100 because the profits exploded higher because the company's now focused on bottom line profitability. So now the PE ratio is useful. So you can look at those PE ratios and saying overvalued. But previously, 2 years ago, when you did, it was simply too early.
So just to clarify, when it was at 1,200, it was useless. But when it's at 100, now you know it's overpriced?
It's a more meaningful number. The PE ratio actually means something.
Just teasing.
Yes.
I think this, it's while fascinating, I think it does sort of bring some insight into why a lot of, David and myself probably like real estate investing, because the reality is real estate investing is a lot less complicated. It's not necessarily all better, but I know that my property mortgage is X and that the rent is going to be Y, and I know what I'm going to make, and I don't have to worry about whether there are ways to misuse metrics, but I don't think so as egregiously.
Yeah, it's not that Tesla is misusing a metric. It's just that you have to understand that mental model in order to do them correctly. And to your point, yeah, there are lots of benefits of investing in real estate. And to be fair, Tesla is probably the hardest company in the world to value, just because its future potential, the range of outcomes from here are still incredibly wide. I could make the argument that this could be a $10 trillion company one day, and I could also make the argument it's going bankrupt in 5 years. Both of those are in the realm of possibility. All right. So the range of outcomes is very, very wide. However, if you were lucky enough to find Tesla 5 years ago, 10 years ago, and make an investment, the returns that you've gotten from it have been astoundingly high, life-changingly high. 10 grand invested in this company 10 years ago is a 100-bagger.
Yeah.
Here's what I say. I'm not sure if this is 100%